All right, well, welcome everyone. Guten Morgen. Dear members, dear friends, on behalf of the German American Chamber of the Southern United States, it's my great pleasure to welcome all of you to our German American Business Outlook 2019. For those of you who don't know me yet, my name is Michaela Schobert. As you can hear probably here and there, I'm from Germany originally, from the beautiful city of Würzburg, the Nowitzki town, even though I shouldn't say that too loud here. And I came over here approximately 5 years ago, leading the consulting department. I took over the German American Business Outlook spontaneously. I flew back in from Germany this Wednesday, and my colleagues were like, "Oh, Mr. Uman," so for those of you who expected a guy here, he actually had to cancel short notice. He's sick. So I chimed in, and I will present our Gabel presentation, which what we call it short, to you guys. But first of all, I would like to say a few words briefly about the chamber and our services that we offer in the consulting department. This is our AC. You have to get used to it. I hope I'm loud enough, but I think so, right? Everybody can hear me? All right. So yeah, just to briefly tell you a little bit of what we're doing, and then I'm going to chime in into the presentation. For those of you who are not familiar with us, we're here now in our Atlanta office. However, and that is probably also interesting for some of you, if you consider going into another country, you will almost always find a German foreign chamber of commerce. So we are currently in 92 countries worldwide. And here in the United States, just because it's a huge country, right, and sometimes not that united with all the regulations and taxation laws, etc., it just so happened that we also have 4 independent offices here out of Atlanta, responsible for the 11 southern states with our subsidiary in Houston. And then our colleagues in New York being responsible for the East Coast, Chicago, the Midwest, and then San Francisco, the office for the Western states. So if you also ever have some business or something going on throughout the United States, let us know, and I'm happy to connect you with our counterparts there. What we do, and unfortunately we don't have that in English, but so basically what our role is to be the official representative of German industry and trade, obviously, and then one of our big 4 sections is the membership, and most of you guys are members, so thank you to all of you who make that happen. And then the other part, which is my department, are the services that we offer. And just briefly, like I said, for those of you, just so that you've heard about it, because I've still come across people who are not totally familiar with what we are able to do and how we're able to support you or your clients, is market research that we're doing, business partner connection. That is oftentimes a value feature. So feel free to always come to us if you're saying, you know, hey, I would like to talk to such and such person in a company. I don't know, you know, I tried it already. Maybe the German American Chamber of Commerce has a better access, or we know somebody there. Business representation, just briefly, most of you probably have seen the signs. We currently have almost 60 companies that we represent here out of our office. So meaning they can use the setup, and that has been developed basically as a quick market entry light in the first step to really, especially for German companies, come over here, start their business, you know, have a first representation like that 9 to 5 office, etc., and have a backup support from us, and then they can really set up their business and focus on business development over here. And then of course site selection if you want to expand, and career service if you need staff that support you. Along with of course all of our members that we usually connect you with, you know, if there are special needs or any specific topics that you have that we can't offer right away, but we have the great network to connect you with. And with that being said, like I said, here you find the colleague from Germany Trade and Invest, an office in Washington, D.C., but they have basically also individuals mainly oftentimes located in our offices at the German American Chambers. There's one in San Francisco, and I think we have it in a slide too. But like I said, these are things that I'm going to kind of browse through. If you're interested, feel free to let me know, let my colleagues know, hand in your business cards, and we're happy to share the presentation afterwards. But we have to talk to Ulrich briefly, who wasn't able to make it, just if he needs to make any adaptations or take pictures on or whatever the case might be. So quickly maybe to the study, for those of you who haven't heard about it or who are not too familiar with it, it is basically a survey that we are doing from the AHK USA, so all of our 4 offices in the United States. Once a year, usually in fall, we ask our subsidiaries, German companies that already have a subsidiary over here, about their predictions of the next year. You know, what do you expect? What are the challenges that you're facing? And what kind of plans, wise, etc., do you have? And then we collect all the results, and then just in the beginning of the year, it has been freshly introduced in New York at our chamber, and now you get the results over here. I think I covered all that. Like I said, I would not really go into detail of what Germany Trade and Invest does, but just to briefly glance at it, it's basically an organization, also maybe for some of you who are interested in expanding business towards Germany. That is our counterpart there, that is able to connect you in Germany. They work closely together with our local chambers in Germany, like the 79 ones in our 16 states. To really be able to mainly connect you and make entrance into Germany easier for you. Along with that being said, if you check out their homepage, what they also do, and they usually oftentimes use our network and our support, is they publish reports on certain industries that you can freely download, etc. So feel free to take a look at it. It's a great organization that has a lot to offer. Yeah, and here you can see the worldwide network. As mentioned, oftentimes they have a representative in one of our offices or close to it to really be within the market and are able to support business best in the country, but then especially also looking towards Germany. The network where we are listed, so if you also come across AHK, so that is basically the abbreviation in German for the German American Chamber Network, or German Chambers of Commerce Abroad, and then the IHKs being the local ones in Germany, along with multiple lobbying organizations, associations that are all kind of like combined within the GTAI network. All right, a few figures. Imports, American imports from Germany, just to have them listed here. You see basically some of the main industries, machinery and transport equipment being highlighted as one of the biggest ones, of course, chemicals and related products, and miscellaneous others. And like I said, unfortunately, if you're interested what falls into the miscellaneous ones, let me know. I'm happy to look it up and give you a feedback afterwards. So now to the study. Like I said, it happens once a year. I think it's our 6th time that we present the results now. And of course, especially within the last few years, it has been very interesting to see what does the German business say, what do they face challenge-wise, and what do they predict for this upcoming year. So like I said, these figures were collected end of 2018 for 2019. So growth expectations for your business, and here we see basically in the blue the flat to moderate growth, and in green a strong growth. So if you put those together, basically still 9 out of 10 companies expect a growth. And again, you always have to have in mind these are German subsidiaries that are located here in the United States. We usually have 2,000 companies that we address with that. And I want to say we have a pretty good feedback, especially this year. Actually, a lot of companies participated. So just to have that in mind. So in a first step, I think that basically sounds still like a very positive number. However, what we want to highlight is that the year prior, so basically 2017 when we had the poll, it was 100%, that's expected growth. So we see a little bit of a tendency in that case already. Oh, feel free, we can take it. Come on in. We're a small round, come on in, no worries. You don't want to miss anything either. Yeah. So growth expectations for the US economy in general, also there, the companies that we asked see, or a lot of them feel like it's a positive climate, and they expect growth in general in 2019. Strategic actions. So the question for this slide was, what methods will German subsidiaries use to grow in 2019? And as usual, the most common answer were the core statements like focus on core competencies, expand sales activities in general, and those are always basically an 80% range. However, this time, the two big changes from prior years were mergers and acquisition and diversification, as highlighted in this slide. For example, last year, only 9%, and you see that in the green line. Only 9% said mergers and acquisitions was a method used to expand their U.S. presence. So this basically now in the blue line that you see has more than doubled, which is pretty amazing. Diversification, the change is not that big, but still 50% planned for 2019 for that to be their biggest strategic action that they will take in the US market. Then the top reasons for future investment in the United States, of course, the big base is the customer demand, 80%, which is oftentimes the case from what we hear, and the proximity to the customer base being 70% in the green line that you here see. Then, as mentioned, we also asked them about their challenges that they face, and I think that is, or part of it is not too much new. Workforce in general, skilled labor is a big issue, I want to say currently worldwide. But what has been mentioned in this study now, and we see it in the next slide a little better even, is the whole visa challenge that companies have. So just for those of you who are not totally aware of it, if you have a company or if you have clients that have a production facility and want to focus on skilled workforce and the apprenticeship program according to German standards, feel free to again let us know. And I'm happy to connect you with our Nicole Heimann, who unfortunately can't be here today, but being the director of the Skills Initiative, and she can support you and connect you on that topic. So here we see it actually a little better. As the survey shows, it became quite more difficult for German companies in the US to receive work visas for their expats. So that has been really a tremendous issue or challenge that we heard over the last few months, where companies really felt the Buy American, Hire American. We just were in Germany at an event with one of the U.S. consulate officers out of Frankfurt, who is responsible for the e-visas, for example, and he said, yes, that is part of our questions now, that we ask the participant or the applicant at that interview, where they only have that 1 minute and they need to perform, they are going to be asked, why you, what do you offer, why do we need to get you over here on a visa, and why can't an American do that job? And then they have to perform in those few seconds or not. So these are really issues that companies faced within the last few months quite a lot. So the percentage has really strongly worsened, It almost doubled from 22% in the previous survey to now 42% in 2018 in some. So yeah, it's a given, I think, the importance of open markets. 72% of the surveyed companies state that open markets are very important, and that is an increase of 19% over the last year. Also for you, feel free, if you want to have the presentations afterwards, let us know, because we came in a little later, so we can send it out. Yeah. Then impact of new tariffs and trade conflicts. While only 39% of German subsidiaries in the United States reported sourcing products from China, a staggering 83%, if you look at the chart, of these companies are negatively impacted by the tariffs imposed by the US to China. So if that's basically, if you again put together the very negative, so we separated the process that they were able to make very negative to negative, and if you combine those, you have those 83%. Then the impact of new tariffs and trade conflicts regarding steel and aluminum tariffs. 19% of the surveyed German subsidiaries process steel and or aluminum, and of those, again, 63% are negatively impacted by the new tariffs on steel and aluminum. Again, the parts together. So, and that is almost the summary already, coming to an end from our German-American Business Outlook. The key takeaways: 9% of the surveyed companies see a contraction for their own business, which is the highest since the recession. However, only 3% predict a contraction of the US economy in general. Then a large increase of German subsidiaries are planning diversification of their business and mergers and acquisition as strategic actions in 2019. And then one other major challenge continues to be finding skilled labor, as mentioned, and difficulties in obtaining work visas have increased to 78% of the surveyed companies. So with that being said, I come to the end of our presentation that I inherited. Again, the full survey will be published soon. I think currently it's not on our homepage, but we will also have it on our homepage, so you can click on the link and download everything. But again, we are happy to get your business card and provide also this presentation.
Good morning, everyone. So I'm happy to say, after seeing your presentation, you're actually going to see similar themes in what I share. So that's always good. I want to make sure when we have this opportunity, what we've kind of realized at the Atlanta Fed is a lot of people don't understand what we do and who we are. So I'm going to spend a few minutes sort of sharing that, and then sharing information about our Regional Economic Information Network. There are several contacts actually that we've made thanks to the Chamber that now feed into our Regional Economic Information Network. And of course, if you're interested, I'm happy to talk to you afterwards as well. So I'm going to talk a little bit about the Fed, like I said, and then RAIN, what we call it, and provide you with an economic outlook. So just to share some background in case people don't know, so the Federal Reserve is actually the central bank of the country and was given 3 primary responsibilities. So most people know monetary policy because that's what interest rates are, and I'm happy to share my slides. Like, they have my slides as well, and they can email them out to all of you as well afterwards. Monetary policy, that's what most people are familiar with interest rates. It's actually the least sort of understood, but we'll talk about it in the economic outlook, and if you have further questions, simply ask them anytime. Supervision and regulation, we are one of the regulators of banks. So similar to the Chamber, we also have a territory. I'll show that on our next slide. And that territory, we're responsible for supervising the banks in our region. And then payment services, we are actually responsible for processing if you have direct deposit or ACH. Whether you are receiving your pay that way, or you're paying maybe your mortgage or your rent or something out of direct deposit, more than likely that transaction is going through the Federal Reserve, and you just never realized it on the back end. The Federal Reserve System also handles wire transfers, and shockingly, there are still millions of checks written every year, and so we process checks as well. Not paper, usually an image, but it's that's there. So when the Fed was set up back in 1913, it was actually the third reincarnation of the central bank. You'll notice that most of the reserve banks are over to the east side because that's where most of the population of the country was at that time. But you'll notice at the bottom it says we're a decentralized structure. Why that's really important and why I want to highlight that right now is the Board of Governors in Washington, D.C., they're federal employees. But every reserve bank, we're employees of that organization. So I'm not a federal employee, even though Federal Reserve is in the title of the company I work at. So when there was questions about the government shutdown, the Federal Reserve is not going to be furloughed because we're not federal employees, the districts themselves. The Board of Governors, while they're federal employees, they don't receive appropriations. So their funds come from the interest they earn on the reserves on the balance sheet. So, and as well as the payment services that I mentioned and the costs we receive for doing those services. So there's no funds to remove, so there's no chance of it being closed, which I think is great, knowing the importance it has to the nation's economy. So I wanted to highlight the presidents and the governors. These are the 12 presidents of each reserve bank. The reason I wanted to highlight them is they're actually the members of what make up the Federal Open Market Committee. They're the ones that do the voting. So each president is actually appointed, since we're not, like I mentioned, any type of federal employee. The 3 women and 9 men that are up here are actually appointed by their own independent board of directors. They're not appointed by the president or confirmed by the Senate. There's no federal involvement in the selection. However, the governors are different. So the governors are appointed by the president and then confirmed by the Senate. They serve 14-year terms. So the reason their terms are so long is it's supposed to be a void of any political pressure. So the chair, so now Jerome Powell, Chair Powell, he serves a 4-year term as chair. So that term is different, but he's still allowed to serve his 14 years. So when Yellen was not renewed as chair, she could have stayed on at the board if she so chose, but she chose to depart early. So just so that's a little clear. So these, and if there are 2 vacant positions right now, they're up to 7 governors. So these 19 people are the people that meet every 6 to 8 weeks to vote on what's happening, and that's where you hear the data releases about the Federal Open Market Committee. Just wanted to make sure you're aware of who those people were. And so we have a dual mandate that we're trying to achieve, which is maximum employment and stable prices. So usually a great way to think of that in an easy term is maximum employment. We're always looking at what unemployment levels are. The Fed has not stated a specific employment rate that we're looking at, but obviously you all know we're in record low unemployment here in the United States, and in some cities it's even lower than national. I believe Nashville, which is also in your region, is extremely low. It's in the 2.5% range. So price stability is the other thing we always look at. The Fed has stated they're looking for a 2% inflation target. And so we'll see as we go through the slides how we're doing with sort of that maximum employment and price stability. So this long acronym that I mentioned and what I do, our Regional Economic Information Network, which is why we call it RAIN, I wanted to tell you a little bit about us. So our president, Raphael Bostic, has charged myself and my 5 colleagues that are up here with going out and meeting with business leaders and saying, what's happening in your business? We have these economists, over 20 PhD economists at the bank, that are studying models of what's already happened, if you think about it. That's what economists do, and then they're making projections forward. But businesses know what's happening today and what their plans are for the future. So when the tax changes, for example, happened early last year, my colleagues and I could go out and say to businesses, well, how is that impacting your plans? Are you making changes to CapEx? Are you doing something to reward your employees? What are you doing? And that information would not be available in the data for quite a while. So we sort of marry the information together, is how I would say it. And our economists get a day with our president right before the final policy process is coming together, and my colleagues and I get a day. And that's how we deliberate and figure out the position of the Atlanta Fed. And so I kind of wanted to just show you a little bit more about how that works. And so I have a video that I wanted to show.
Some people think our economists and policymakers never get outside of the marble walls of the Fed, that they don't know about this remarkable interaction between the people at the Federal Reserve Bank and the community that we serve. Our bank representatives go out and collect information by talking to people. This program came about because we realized there was a wealth of information that we wanted to be able to tap as we went about the business of trying to understand what's really going on in the economy.
I think the economic data that I share with the Atlanta Fed is used as an anecdotal confirmation of what the Fed economists see in some of the data. The questions revolve around employment, inventory, wage growth. For us in automotive, it might be about auto loans. Are we seeing a lot more people taking out credit, or are they paying cash?
The airport activity depends very much on what the economy is doing. I meet frequently with our bank representative, and we talk about what's happening with the economy. People can't believe that I'm engaged in it. I'm not an economist, I'm not a financier, but I certainly am at the heart of observing what's going on in the community.
In addition to getting the insight of the Federal Reserve's economists, it's a chance for me to learn a little bit more about what others are seeing that are not necessarily in my industry. The Fed resources that I use the most are the monthly reports, which give a running update of what's going on in different sectors of the economy, particularly areas like retail that I don't see a lot of. You get some indication of sentiment. You know, what are people thinking? Because those are my customers. So access to that type of information is really, really valuable.
It's a unique opportunity to be able to share what's going on in the grassroots level and to have the Fed listen to us and to actually craft policy based on a lot of the things that they're hearing is a very important opportunity. The information that we share is passed on to the president of the Fed, who is listening.
Miami is a small business community. That is a business that do not have the privilege of having economists on board to be able to help them guide their decisions. So having access to the brain power of the Fed and having the opportunity to have substantial data.
So I hope that sort of demonstrates what we do. Very similarly to the chamber, we have a territory, as you probably saw from where they were, the different places that were visited. We're mostly in the southeast. We cover Florida, Georgia, Alabama, and then the lower half of Louisiana and Mississippi and the eastern half of Tennessee. I cannot explain the division. I don't really know myself. But we are responsible for going out and talking with those businesses. And as you can see, we try and get diverse businesses because different businesses have different impacts on the economy, as well as sometimes they're impacted differently about what's happening in the economy. A lot of academic institutions, if the economy is not doing so well, might actually start doing better because people are going back to school, looking to get new opportunities, new degrees. So it's important that we capture sort of all sectors of the economy. So the other ways we get information is we host different roundtables. Sometimes we do that if we're struggling to get a specific sector of the economy and we're trying to get that information. Other times people ask us to, and it allows us to hear what's going on in their economy and ask and share information about what we're hearing. We also have various advisory councils that we talk to, and they're pretty specific to our region. So we have one that's energy, we have one that's travel and tourism, we have one that's community bankers, so we have several here. And I should mention the structure and how we do this is independent to the Federal Reserve Bank of Atlanta. Not every reserve bank does the process we do, but this is how we gather our economic intelligence. The last thing I want to mention is surveys and publications. So similar to the chamber, we actually have various surveys that we do. We have a monthly survey that has some data I'm going to share with you in a month. So from all those meetings, what are we hearing? And I would love to hear if this is what you're hearing as well. So what we're hearing, very similar to what you talked about with the outlook for 2019, is that overall 2018 was a good year. People had strong business, but for 2019 there's a lot of uncertainty going around. People are concerned with trade and tariffs. People are concerned about the global slowdown that we're hearing about. People are concerned about what's going to happen with immigration. So there's a lot of uncertainty and people don't know how that's going to impact 2019. I'm going to guess that's very similar, but I don't know if anyone wants to share anything that they feel is different. So regarding employee retention, what we're hearing is that most employers are focused on retaining the employees they have. It's easier to keep the employees you have as opposed to go out and find new employees, because if you're struggling to find, particularly in those sort of hot areas like technology or healthcare, data analytics, you might be better off giving a higher increase to the staff you currently have as opposed to trying to recruit someone new to fill that same role. Most of the wage pressure, though, what we're hearing is in that low-skilled, hourly type jobs. And then merit increases, while we hear a lot of people tell us that they are feeling wage pressure, we're still seeing merit increases around 3%. And that's actually ticked up from what we were hearing, sort of in the 2.5% to 3% range. Now it seems solidly in that 3% range, unless maybe you're in one of those hot fields. Any differences? Anyone see anything?
I gave
all of them. So you did it across the board.
Except for two.
Okay. All right. Well, it's always interesting. Well, the reason I ask that is some people do it all across the board, and some people stagger it. So it's always interesting to hear what companies are doing. The last thing we're hearing about non-labor costs, which are basically it could be your supplies, anything, your rent, anything that impacts your business other than your people or your insurance, is that anything impacted by tariffs and freight, people are concerned. Particularly with the March approach of we don't know what's going to happen with tariffs. So there's a lot of concern, back to that uncertainty. But if there are tariffs and freight involved, more people are passing along those increases than other areas. But a lot of businesses still remain hesitant to pass along a price increase. There's a lot of concern if the 25% tariff comes into play of what you're going to do with prices then, because a lot of companies that we've talked to feel they're going to have to pass along a significant price increase, and then that has them concerned about what's going to happen to sales and demand. Anything different from anyone here? I'm going to make you talk.
I have a question on uncertainty over trade. How is the trade issue affecting the German-American relations? Meaning, our headquarters are in Germany, and we buy parts from Germany, and how does that affect us as a small company?
You know, honestly, I don't know that answer. If it's with your own, own country and in your company, and you're importing them here.
We're importing products here, but the question is, we also have manufacturing, in China and other areas of the world, and we're concerned about how those tariffs are going to affect us.
Yeah, I don't know. I'll have to look into that, and maybe I'll get your card and see what I can find out and email you back about that. I actually don't know when it's your own company in your home country how that works. I do know that what we're hearing from a lot of contacts who are bringing things over from China, that they're trying to move. There's not a lot of domestic suppliers necessarily that can provide those same goods. So they're looking for other places, and Vietnam, Cambodia are the most common places we're hearing. But the infrastructure in those countries is not prepared to handle the increased demand. It doesn't have the staff there or the skills to make the supplies, and then their ports can't handle the volume of stuff that needs to come in and out. So I know that, but I'll have to look that up.
The uncertainty for us is that we had basically free trade the whole time.
Yeah.
And now suddenly we're hearing that Chinese goods made in China are not going to be hit at certain tariff rates that we have to now absorb.
I would wonder if they
Pass it
go,
on.
I wonder if you ship, my main thought, and this is simply a guess, and by the way, if I didn't say this, these are my thoughts, and I speak for myself and not the Atlanta Fed. There was a disclaimer at the beginning. Or the Federal Reserve System. So just so we're clear on that. But my thought would be, I wonder if you could, if they're diverted first to Germany and then here, if that would maybe take it around the tariff, but I honestly don't know.
That's a separate discussion.
Yes.
Outside this group.
Yeah, but I honestly, I don't know.
We've already implemented a lot of
Okay.
different things that I can't talk about.
Oh, anyone else have any commentary or anything?
But still, country of origin will come into play regardless you take it to
That's
Germany or
true,
wherever you
that's
are.
true. I have talked to a company that is doing the last finishing of a product somewhere else, so they can put the tag on,
Or
it's-
assembled in other place, so that might make some difference.
but I don't know if you're a foreign company and you're bringing it from, I'll have to find that out.
Yeah, but it's very interesting to know
Yeah.
if it's like engineered in Germany, manufactured, where's the country of origin?
Yeah, then what percentage,
The
and that will come into play.
I can calculate that for your company if you want. That's for a living, is we go through and help supply chains calculate, one, how much they put into a local economy, and two, what the impact they leave behind.
There you go, I helped give you a plan. Okay, so hopefully I showed that we take all that information along with the economic forecast and our expertise from our economists, and we come up with an outlook. So what is that outlook? So what we heard, this is just a summary, and then I'm gonna talk about GDP, and then about inflation, and then about labor markets. So what we heard, as I said, 2018 was a strong year. Companies were still growing. But we expect GDP to come in around 3%. I actually think now it's slightly lower. We don't know the total impact from the government shutdown. We still don't have all the numbers. So I think now we're hearing 2.7 to 2.8 could be, but somewhere around that 3%. It was interesting to hear your 2019 forecast. So we're still hearing that 2019 is going to be a good year. It's going to be a solid year. It might not be as strong as 2018, but companies that we've talked to and the economic data that's being projected says that 2019 will be a good year. We already talked about the risks. We kind of look at risks at the Atlanta Fed as to the upside, sort of neutral, and to the downside. We see them tilted to the downside just because of the level of uncertainty for those things. As I talked about, job gains have been strong. We've seen pretty close to full employment. We've had in the last few months some record low unemployments in our country that are 50-year lows. Inflation is close to that 2% target. And the Federal Open Market Committee is still trying to get back to what we call a neutral rate between that 2.5% and 3%. Almost there, not quite. So we, in our survey that we did, we do a survey this monthly. And if you're interested, let me know. Right now we survey about 500 different businesses. But we're actually trying to raise that. So it's primarily CFOs and CEOs that fill out the survey. It's anyone from a self-employed individual to Fortune 500 companies, so it's a diverse set. But we ask them about 10 standard questions every month. It is a monthly survey. And then once a year or periodically, we actually have special questions. But once a year, we always ask, what's your biggest concern for the next year? So when we asked at the end of 2018, what is your biggest concern for the year? And I don't know if you can see it because the bright sunshine that just came in. But everyone from the blue bars are 19, the orange bars are what their concerns were for 2018. Remember, this was taken at the end of the previous year. So as we came into 2018, trade was on no one's mind, right? There was no discussion of trade tariff. This year, 45% of people that talked about cost were talking about tariffs. Similar to labor costs and other things, insurance that we've heard about. But the other at the top of the chart is labor quality and availability. We've heard companies tell us that sometimes they can't find the labor they need, or people don't have the skills that they need. And then in general, people are more worried now about the health of the economy than previous years. Anyone surprised by what we heard in our survey or think something should be higher maybe than others? I'm sorry, I'll write it. So wanted to quickly talk about the impact of the government shutdown. We all know the number is 800,000 people, but we know it's broader than that because there are businesses that depend on those. So with the Congressional Budget Office, they came out after the shutdown closed and said the impact of that. There was a delay of about $18 billion. The thing to remember is $3 billion of that is expected not to be recovered. And so it's expected to cause about 0.2 percentage points on GDP in 2018, and going forward, it's estimated to be about 4 percentage points on this year. And if there's a future shutdown, we don't know the magnitude. Could it impact tax returns? Could it impact other spending and other delays? We just don't know. I think everyone probably hopes there's not. So what are professional forecasters saying? So the green bars on this is what's already happened. The blue bars are predictions. And then I'm going to highlight the red. So the top red line is the most optimistic, and the bottom red line are the most pessimistic. So you'll see for 2015, GDP pretty much has been ticking up, and it's starting to come back down a little bit. Most blue chip indicators think it's going to start to tick down like we talked about as we head into 2019 and 2020. The most pessimistic of those are thinking we might come closer to 0 in 2020. So what does the Federal Open Market Committee say, right? They're the people that vote on the rates here. So what are they saying? So I don't know if most people know, but the Federal Reserve publishes something 4 times a year called the Summary of Economic Projections. And it's available on the Board of Governors website. It was last done in December, so remember this is December data. I believe the next one is in March. But this asked them at the time, so this is those 17 people, I'd asked them what do they think is going to happen. So I know this chart looks crazy, so I'm going to explain what it means. So the sort of eye-looking figure, that's sort of the range of the predictions of what the Federal Open Market Committee members are saying. The red line is the median of them together, and the blue bar that's smaller is where most. It's sort of taking out, I believe it's the top 3 and the bottom 3, and saying where do most feel it will be. So most believe GDP for this year, like we said, is going to be close to 3, and then start to head down and get closer to 2 in the long run. And so there's not a way to technically measure inflation. So what we look at the Fed is something called the Personal Consumption Expenditure, PCE, price index. So I know you see 3 lines here of PCE, and you're like, okay, this is PCE, how are they different? So the blue line is everything together on goods and services. These are those prices. The green line for PCE basically takes out energy and food because those prices are more volatile. So taking that out, and then the orange line, the trending PCE, is actually something that the Dallas Fed puts together. And I don't know all the details, but it's thought to be closer, taking out some of those the additional volatility. But again, as you see, they're all coming close to that 2% range as we head into 2019. So again, using that summary of economic projections that the Board of Governors does, those people, what are they seeing? So they're sort of seeing inflation starting to tick up, you see. And as we head into 2020 and 2021, it actually looks like it's going to go above that 2% range. And then maybe in the long run, come back down to 2%. So back to the survey, I mentioned that monthly survey we do of 400 to 500 different businesses. We also ask every month, what do you think is going to happen with inflation? And so for the last 5 years, even though this is spread out and you see some volatility, really what the companies have said that we've talked to is inflation will be somewhere between 1.7 and then it's ticked up to about 2.3%. In January, our survey just closed January 31st, and it was back down to 2%. So talking about labor and what's happening there, the one thing we wanted to point out is since the time of the Great Recession, and as that concluded, you'll notice the blue line is sort of a 12-month average of how many jobs we've been adding. So over that time period, we've added around 234,000 jobs every month. This month, the jobs report came out last Friday. You might have heard it was 304,000 jobs. That was much stronger than we expected, especially with the government shutdown. So all signs that the economy is doing well. So what's happening with unemployment? So we look at, the blue line is called the U6, and the green line is called the U3. I'm going to come to that on the next slide and explain that a little more. But what I wanted to point out is labor force participation. So you'll notice the orange line before the recession in 2017 was around 66, and now, it doesn't seem honest. I'm so sorry that happened. It's now around 63.2. So we don't know why the labor participation rate is still not as strong as it was before the recession. We don't know why people aren't coming back into the workforce. What we do know is that unemployment is lower. I know a couple people have asked me before, does that have to do with older workers, leaving or coming back in? What I can tell you is the only area of the labor participation rate that is growing is that for ages 55 and above. So I said I'd sort of explain that U6 and U3. So at the Atlanta Fed, we like to look at the U6, and that's because we think that gives the whole unemployment picture. So the orange that is shown here, you can see how the unemployment, and that's when you hear unemployment reported in the news, that's what they're talking about, the U3, and sort of those orange blocks. So you can see it was about 4.7, it ticked up to around 10%, and now we're back down to 4. A few months ago, we were at 3.7. The green is what we call marginally attached. So when someone's marginally attached, they've looked for a job in the last 12 months. They've just looked, just once, in the last 12 months, and they're considered marginally attached. Part-time for economic reasons is the blue part, and the marginally attached and the part-time for economic reasons are what makes up, in addition to the regular unemployment, the U6. Why we look at that is there are a lot of reasons someone's part-time for economic reasons. They may be part-time because of their lifestyle. They have to take care of their children, and they can't. They can only find part-time work, but they really want full-time work. They might only be able to find part-time work and really want full-time work. So there are a lot of reasons someone could be part-time for economic reasons, and so that's something we look at. If you are part-time in 2 jobs but have enough hours to be considered full-time, you're actually considered a full-time employee.
I was just going to ask, how does the gig economy factor into this? Are those people considered part-time?
And they have enough hours to be 40 hours of any jobs together. So let's say I'm, an Uber driver part-time, but I do something else, then you'd be considered in the whole labor force. Gotcha. You would not be considered a part-time for economic reasons, unless that's the only job you could find and you really wanted more hours. So what are we hearing, or what are the projections for what's going to happen with unemployment? Pretty consistently, you see the left-hand side is what's happened with unemployment. The green line going up here is what the Wall Street Journal, the blue is the blue chip, and the red is the FOMC. You can see other people are a little more, I'd hate to maybe say pessimistic of what's going to happen with unemployment than the Federal Labor Market Committee. But with wages, you'll see we're starting to tick up closer to where we were before the recession started. I think we were at, in January, I think the number is 3.2, don't quote me on that, but we're over, starting to get over that 3%. And so what is the Federal Open Market Committee, what are those people saying? So their projections in December, and by the way, when they do these projections, it's on the data at the time, so they could change again in March of what they will say and the ranges they pick. But you'll see, again, it starts to tick up a little bit. And then in the long run, they think maybe a more natural rate might be in that 4.5% to 5% range. So what happened at the end of January? And I'm sure everyone heard this, and whatever news source you listened to probably picked up the word that we're emphasizing. But I think the Federal Open Market Committee in the long run said we're going to be patient, and we're going to pay attention to the data. So I hope that was the message that came clear. They held the rate steady at that 2.25% to 2.5%, but that's still not in what we consider the normal rate. And so I imagine that will be a plan to, when the numbers say they can, try to get back into that normal range. And so what do the committee members think is gonna happen? Well, you'll see in 2019, when they were projecting in December, it's kind of split, right? There are a few of them that think it's gonna tick up in 2019 all the way to 3%, and there are a few of them who think it's actually gonna come down a little bit lower than what it is. And then as we move into 2020, a little bit higher, and then again, maybe a little bit lower. So in a way, one of my colleagues pointed out, it sort of looks like arrows. And so maybe that is, but you can see in the long run, it is in that range of the 2.5% to 3%.
Just when those 19 people meet,
Mm-hmm.
what number is required to approve a hike in interest rates?
I've never been asked that. That is a great question. I think they have to come in I think it's a majority overall, but it's a 2-day discussion. So I think overall they have, from my understanding, they have their statements and what they want to do, but I think they pretty much come to agreement on what they're going to do, but they do take a final vote at the end. And so all 19, 17 now do not technically vote. The governors always vote, and then the presidents vote on a rotating basis, but the majority has to do that. But I'll confirm that and also get back and let you know that. So there's a lot of questions, and a lot of people want to know about the balance sheet. People are talking about what is the balance sheet. They hear about it, they don't really understand it. So hopefully I'm going to try and make it a little bit easier to understand. So you'll notice before what we call the Great Recession, where the Fed's balance sheet was, it was just under $1 trillion in 2007, 2008. This blue box here are mortgage-based securities. So the Fed purchased a bunch of mortgage-based securities to try and pump up the economy and use that. That's one of our monetary policy tools. The plan in the long run is not to use that as our primary tool. It's to use interest rates. So you'll notice in 2017, the Federal Open Market Committee came out and said, we're going to start letting those mortgage-based securities, as they come to maturity, we're just going to let them roll off the balance sheet. Not too much, just $50 billion. No more than $50 billion out of $4.5 trillion, right? Come off at any month. And so that's sort of been what's happening. And the thought is we'll see how that happens, and if action needs to be taken while we try and reduce the balance sheet, the action will be taken with interest rates, the primary tool the Fed uses to work with, to handle monetary policy. But what the normal rate is usually, or what the normal balance sheet level is normally a question people ask. We don't actually know. We don't think it's back to around $1 trillion, because that has been 12 years. But we don't think it's at the level we're at now. What I like to, a good analogy for people, and since I work in anecdotes, I think it's great, is if you're in a car, the Fed is not trying to press on the gas, and it's also not trying to press on the brake. We're trying to coast and let it see what happens. And that's kind of when our president spoke in Chattanooga last month, it's pretty much what he said. He said he's going to try and be as specific as possible and be patient and see what the data says. There's one more thing I'll mention. If you want more data on the balance sheet normalization, we actually have a macro blog on our website that one of our economists, and sometimes Raphael himself will post things on. He posted something about balance sheet normalization and his thoughts there. If you're interested. And that's all I have.
Are there any questions in this big setup for one of us? Thank you again for your more detailed presentation, survey, and the outlook. Questions? Otherwise, I think some of you already asked. Feel free, again, we're both here for a few more minutes. feel free to network, grab some more food, some more coffee. We can be here for another half hour if so. So feel free to get to know each other. Thank you for coming, and I hope to see you guys soon.
And I'll just add, if you're interested in being part of our Regional Economic Information Network or participating in our Business Inflation Expectation Survey, come see me. You can exchange cards at Regional.
Thank you.
Thank you.